The firm's primary objective in producing output is to maximize profits. The production of output, however, involves certain costs that reduce the profits a firm can make. The relationship between costs and profits is therefore critical to the firm's determination of how much output to produce. A firm's explicit costs comprise all explicit payments to the factors of production the firm uses. Wages paid to workers, payments to suppliers of raw materials, and fees paid to bankers and lawyers are all included among the firm's explicit costs. A firm's implicit costs consist of the opportunity costs of using the firm's own resources without receiving any explicit compensation for those resources. For example, a firm that uses its own building for production purposes foregoes the income that might receive from renting the building out. Another example, consider an owner of a firm who works along with his employees but does not draw a salary. The owner foregoes the opportunity to earn a wage working for someone else. These implicit costs are not regarded as costs in an accounting sense, but they are a part of the firm's costs by doing business. While economists discuss costs, they have both in mind, explicit and implicit costs. Two other costs are fixed and variable costs. In the short run, some of the input factors the firm uses in production are fixed. The cost of these fixed factors are the firm's fixed cost. The firm's fixed costs do not vary with the increases in the firm's output. The firm also employs a number of variable factors of production. The cost of these variable factors of production are the firm's variable costs. In order to increase output, the firm must increase the number of variable factors of production that it employs. Therefore, as the firm output increases, the firm's variable costs must also increase. Total and marginal costs are two more. The firm's total cost of production is the sum of all its variable and fixed costs. The firm's marginal cost is the per unit change in total cost that results from the change in total product. Marginal cost and marginal output are both important in figuring out the costs. The firm's marginal cost is related to the marginal product. If one calculates the change in total cost for each different level of total profit reported and divides the corresponding marginal product of labor reported, one arrives at the marginal cost figure. The marginal cost falls at first, then it starts to rise. This behavior is the consequence of relationship between marginal cost and marginal product and the law of diminishing returns. As the marginal product of the variable input, labor, rises, the firm's total product increases and the rate is greater at the rate of the new workers hired. Consequently, the firm's marginal cost will be decreasing. Eventually, however, by the law of diminishing return, the marginal product of the variable factor will begin to decline. The firm's total product will increase at the rate less than at the rate new workers are hired. The result is that the firm's marginal cost will begin rising.